The executives that run big US banks talk about recession like it's a bad thing. It is, but maybe not for them. Jamie Dimon, the chief executive of JP Morgan, puts the chance of a US recession at around 20 to 30%. But he says there's the same chance of what he calls something worse. A recession means joblessness rising. It means households potentially struggling to make ends meet. It's clearly not a good thing for America in general. But banks are already prepared for a recession. For one, they're forced to be by the Federal Reserve, which runs regular stress tests and compels lenders to keep plenty of profit stored in anticipation of loans to customers going bad. And over the last couple of years, there's been plenty of profit to put aside. Jane Fraser, the chief executive of Citigroup, said in July that banks in a recession depend on various things, including their past profits and their access to cash, but that she feels very good about all of them. Banks are also more relaxed than they could be because since the financial crisis of 2008, they've got rid of some of the riskiest kinds of activity, things like offering second mortgages or making loans to private equity firms. A lot of that's now done by non-bank lenders, often called shadow banks. But here's the real secret. Not only could a recession not be terrible for big banks, it might actually be good for them. Dimon has pointed out that in a recession, certain things get cheaper. And one of those, unfortunately, is employees. More importantly, while banks may be prepared, many of the new fintech firms that are trying to steal their business, whether it's through buy now, pay later or online stock trading, are not so well positioned. Since a recession is likely to wipe some of those companies off the map, it's not hard to see why banks might be less anxious than they first appear.